A lot of people trading ICT or smart money concepts fail to choose the right liquidity level and keep losing to fake liquidity sweeps. That's why I decided to make this video showing you my favorite liquidity level that's better than any level I used before, and it gives a high probability liquidity sweeps or delta soup entries. I'll cover everything you will need about it, so make sure you watch the video till the end. Let's get into it. Now, most likely when you were introduced to ICT and you started learning about liquidity, all what they taught you about, and I mean including me when I was talking to beginners and teaching beginners the basics, you got to go over the basics, which is normal highs and lows, equal highs and lows. You want to look for reversal at those levels, the equal highs and lows, for example highs, lows, as well as trend lines. And I also went over the sessions highs and lows, and time-based liquidity, including previous monthly high and low, daily, weekly, and it goes on, right? Today it's going to be different. We're not going to be going over those. And what's the reason? It's not that those liquidity don't work, but the probability of those levels is less in probability. When just going and taking a look at any higher low, it's really less probability to have that reversal, that turning point, and then go into the other direction. For example, we can see if we're just looking for any high and low, this low here, we just broke below it. There was maybe an indication of a reversal here, but then it kept going lower. Same thing here. It was not that strong move, even though it works, but it doesn't have that high probability entry that you can get, and you cannot trust it. The same as the level of liquidity I'm going to introduce to you today. Now, just a disclaimer that I've talked about this before, but not in this way and not in this much details. What are we going to be covering? And based on my gold trading strategy, we discussed that we always look for a market structure shift or a higher time frame change of state delivery in order to know where the market is heading to, and then look for our first mitigation liquidity. That's the liquidity I'm introducing today. You can use it, in any asset, not just on gold, even though it really performs very nicely on gold. What we're going to be looking for is we want price to reach a POI or a liquidity level. Price is going up to that POI, and then market structure shift. So let's say we got that market structure shift here. The moment we get that, that's a confirmation that we might be heading lower now, because we got that, first of all, that mitigation of the higher time frame POI, a market structure shift. What will happen most of the time is price, let's say that we have a fair value gap here created. What will happen is price will come to that fair value gap just like this, and then reverses from here just like this. A lot of people would be entering either at the fair value gap or at the reaction of the fair value gap, having a stop loss above that high, right? And then targeting any other liquidity level. Let's say this one here, we're going to be targeting that liquidity level. The truth about this is, and just have it as a rule of thumb, most of the time, if price is still not in a rush to go lower, right, it still did not reach the drawn liquidity, the main one, or if we're completing a market maker's model, let's say this is a whole market maker's model and this is the external liquidity, this right here, price will tend to go there, right? But before going there, it's going to have a lot of traps and a lot of inducements. This is the most important inducement level we're going to cover. So you see this trade that a lot of people enter, price will go lower until here, and a lot of people would go break even at this level, and then they're going to wait for the liquidity level, the external one, to be hit. What's going to happen after is price going back again to the first mitigation, and then the remove is going to start from there. So you see a lot of people, and I don't know if you can relate to this, but have you ever entered a trade, get a reaction, and then you said, okay, just because it looks like we're going lower from here or higher from here, then I'll put my stop loss at break even. Let's say it's a bearish example. I'm going to put my stop loss at break even. Then eventually price goes up to your entry or to the high that you entered from, not going to your stop loss, but you're out at break even, and then the real move starts after. Have you ever experienced this? So let's say you entered from here, you put your stop loss, it was somewhere in here, you put it at break even, you get stopped out and break even, and then the real move starts. I'm sure that you can relate to this. What's the logic behind this is that early sellers entered here, price goes lower, early sellers are getting stopped out here, or people who go break even are out, then the real move starts. So it's all about identifying where the market section shift is, or you could use the higher time frame CISD in order to determine a lower time frame market section shift. We're going to be looking at the first mitigation and a sweep of that mitigation, which is going to be an inducement, right? So the entry would be at this level. Sometime price could go up again and then give another sweep and go lower, and we're going to see some examples of this. This is the signature in price action that you want to see, and you'll realize that this actually happened a lot of the time, and this is the liquidity level that will never fail you. I mean, in the long term, using this, you're not gonna fail as a trader. Let's go to the chart now. Just a disclaimer that this actually works on any time frame. Like even if we go to 1 minute time frame, we could see it. But let's do a little bit of a higher time frame and see how good this level of liquidity is. Now, going back here, all what we want to identify is what? You know, I really prefer to see price going into a POI and then a market section shift, which one of those I can see here. You see, we sweep this liquidity, we sweep also this liquidity, and we get a market section shift. Now, at this leg of the market section shift here, do we have a fair value gap? Yes, we have this one. And a lot of people here would think that this fair value gap now is mitigated, and they're going to look for higher fair value gaps to enter from. But the reality is still, those are early buyers. Most of the time, if price still not in a hurry to go higher, it's going to take this again. And what do you see happening is what? Price sweeping that level again, going higher. What happened after? So this was out of kill zone, so there was not much displacement to happen here. But what do you see happen after? Is another sweep into the OB, and this is where the lender kill zone start, and then the real push happen. So let's forget about this one because the mitigation happened in a kill zone, but the inducement or the liquidity sweep after did not happen in kill zone. So automatically it becomes a lower probability one. What do you see after is, let's say this one here, a breaker structure to the lower side. That's the one here with a fair value gap. So that's a high probability one. We get a fair value gap here. Where do we mitigate the fair value gap for the first time? You see, we have two fair value gaps here. So I could mark them both, and we can see that first mitigation is this one. What does this tell us? Now, I'm going to also show you something very nice after this, but let's focus on this first. You see, first mitigation, which is early sellers participating here, right, in this fair value gap. What happened after is price keep going lower, 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 but at some point, it went up to that same level where there is a lot of orders above this, especially stop losses and entries, and taking it out here, a very high probability sweep, then pushing lower. Do you see what I'm saying? Now here is the real one. This now becomes a strong high, especially when it breaks structure. But regardless of this, what do we see? We took liquidity and we started going lower with a CISD. Now the low between this high and this sweep becomes the high probability liquidity level. So you see, what is the lowest low? This one or this one? Actually, this one becomes a high probability liquidity level also. So you taking that one, we got a bit of a reversal, but we're not planning to enter from here. We're planning to target this low. But what do you see happening here? Also, we sweep liquidity, we go lower with a displacement, and then we had a fair value gap, right? So we got a displacement, fair value gap created here. What is this now? So we got a balanced price range, but we get first mitigation. This first mitigation, what does it tell you? We got early sellers entering here. If you're someone who enter off fair value gaps, then yeah, maybe this one. But if you're someone who trade, liquidity levels and turtle soup, then your entry would be most likely at the sweep of the first mitigation. You see, really the sniper entry here. Then what do we target? The low in between. So we have this high and this high. What is the low in between? It's this one. That's the one we target now. You see, we took that one. We push higher now. Now we have no significant fair value gap here, but we have, again, this one is not fully filled yet. Price, if not ready to go lower now, it could grab more liquidity and then pushes for the last time. Most of the time we want to focus on 3 pushes inside of the fair value gap. So we got the first one here, second one here, the third one would be really the highest probability one, and you see, taking this liquidity here. Now again, for the take profit, what do we target? The same thing is the lowest low between this high and the sweep, right? What is the lowest low? It's this one. This now becomes high probability liquidity level to target, and price actually reached that level. So this is how we approach the inducement levels or the first mitigation level. And this happened over and over. You could see it everywhere. You just try to identify where the market is going to and then go from there. Same thing here. We can see that we inverse this fair value gap, and then we had a lot of fair value gaps here, but because price was in a hurry to go higher, it did not retrace all the way to the extreme fair value gap, but into this fair value gap here. So let's consider those all as one fair value gap, because in the higher time frame, maybe in the 4-hour or the daily, this is going to be one single fair value gap. Actually, the 4-hour. What happened here is price mitigate. If we want, a very precise one, it's going to be this. This is the first mitigation right here. So this is the first push. Swept here. That's a high probability one. Pushes higher, but in this case, it was not really the biggest trade, because the highest high between is this one. So it was reached. But then the third push, which is most of the time the last one, is this one right here. Sweep into a fair value gap. Where is the highest high in between? It's this one, and it was taken after. So it's all about this kind of pattern, which is going up, taking a low, and then taking the high, right? And I've been teaching this for a long time in my mentorship, and a lot of people finding success. You see what happened also here. Same thing keep happening over and over. Unless the whole fair value gap is filled, then the probability becomes lower. But you see what we had here is a breakout structure, but while getting that breakout structure, we had fair value gaps too, and mostly it was filled mostly, but it's not. There is a small part of that fair value gap still not filled. And you see what happened after? Because this is now a low in a fair value gap, taken here very nicely, and then it keeps going higher. Now, because we're dealing, this is the same as dealing with market makers model. When dealing with market makers model, what do we have? We have price going up, creating an external. Whatever happened here is internal. We go and into a fair value gap or taking liquidity. And then what do we target now? This is all internal. If we are in that clean move of internal to external, it's this high here. It's the highest high in this range, which is this one. And we're going to target that one. The same thing happening here. With this logic, we have sweep. What is the highest high in between the first mitigation and then the second, or the second and third? It's actually this one right here. This is the high. Then that becomes high probability liquidity level to target. Snapper entry here, targeting this one. The moment you realize how good this one works, you'll be asking yourself some question. One of them is, why do a lot of ICT teachers, for example, or YouTubers, or some people teaching ICT, they tend to say that when price goes into a fair value gap, it's already fully mitigated. And that's totally wrong, because that mindset now is creating a lot of liquidity around that level. That's the mindset that made this as a high probability liquidity level, because it's creating more orders at this level. Now you see, still in the 1 hour, but just very quickly show you how well this works. You see, we had a breakout structure, first mitigation, sweep, targeting this low. Again, we see first mitigation here, right? Sweep, targeting this low as well as this one, and then going up again. The second mitigation taken here, price goes lower. And we can see there are some ones don't get the enough momentum. For example, this one, even though it's a first mitigation, we take it here, goes lower. Not a lot, but still, this one can count as a very good trading opportunity when entering on the lower time frame. Now, going over gold in the 4 hour, just to show you that this can work on any time frame. You see how we had a change of state delivery here with a fair value gap, but because this fair value gap is now fully filled, there is no business above this high. Mostly price will not go back there unless it wants to take those relative equal highs. So it wants to take this high as a drawing liquidity, but there is no liquidity sweep that will happen from this point, especially that we already also filled and mitigated this extreme OB. So it's not going to be the highest probability. But what you see happen here is breakout structure. You can see this one here. And what happened is creating this low as first mitigation. What happened after, if you can see, sweep going higher. Very nice snapper entry. You could have taken this turtle soup going higher. Now, same thing is here. We had CISG to the lower side, first mitigation, but it did not give us that big trade here. but a lot of the time it's still gonna stick to that rule of the high in between. For example, we can see again, we break structure, 2 fair value gaps here, or maybe 3, right? And then first mitigation here. First mitigation taken, what's the highest high in between? This one right here, we take it and we take the high. Now again, what happened after is, let's say, even in this leg, right? This one as well as this one. You see how it happened at the same time. We get displacement, first mitigation here, we push lower, and then taking it here, targeting this low, as well as the external. Same thing happening here, going up, first mitigation, sweeping, was the highest high in between. It's this one, taking that one. You see how it's very, very smooth that you cannot unsee it. You see here, we actually pushed higher, we came lower, part of the fair value gap is still unfilled. This is now is an inducement level, taking it here, we push higher, level here, taking it here because we have a very small fair value gap. Price comes here, this is now inducement level, going higher. This is the sequence of the market. Price, for example, giving you a market section shift, going up, giving you that first mitigation, sweeping that first mitigation, I would say a deeper retracement into your fair value gap, and then pushes lower, mostly taking this low as well as this low, right? And then targeting those lows. It's going to have that move of the internal to external and the low in between. That's it for today. A very short lesson, but very important one. I promise you that if you apply this, you're going to see a lot of improvement in your trading, because this is what I've been teaching, part of in my mentorship. This is what I've been convincing people. Look at the market in a different way. Look at where the mass are entering, where most of the people are entering. And then this is where we have a lot of orders to target there and to take advantage of. If you like this video, then make sure to share it with some of your friends, maybe someone in need of this knowledge. Also subscribe and like the video, leave a comment. This is Mulham, and I'll see you in the next video.